Now, I want to talk more about this risk curve that you mentioned and all the points along the way of that risk curve, whether it's like off-chain lending at the very end or Bitcoin and cold storage at the very beginning of the curve. Is there a progression that we have to go through to fill out this curve, or is it all going to happen at different points of the curve at the same time? And the reason I'm thinking about this is like in Bitcoin, on chain, Bitcoin the asset, I guess we often view it as a progression of, first store of value, then it's a medium of exchange, then it's a unit of account. Does this risk curve also happen in a progression, or can it happen everywhere all at once?
So it's something like a combination of both, but I do think there is some element of natural progression. To use like the United States dollar capital market, for example, physical gold was the very first base layer of the United States dollar capital market, right? At the very bottom was physical gold. People were very frugal and they were very fiscally conservative. Many people would hold the gold themselves. They would only entrust goldsmiths that they knew in order to issue deposits on top of the gold and transact with one another. And that was a function of basically this market being in its infancy. And I think right now we're seeing that exact same thing. People are using Lightning sometimes, but you'd be hard pressed to find somebody who owns more of their Bitcoin in a Lightning Network channel than they do on their cold card. But that doesn't go the same for a U.S. dollar capital market. There are several market participants, I'd argue basically everybody, who has the majority of their wealth in something like bonds and equities, at corporate bonds and in stocks, than they do in physical gold. And I think that's a function of the capital market maturing and more liquidity being parked in it, making it safer for market participants, right? That way, they're more comfortable taking on an outsized amount of risk and moving up the risk curve, right? And new instruments being created that are riskier. When you've got the United States dollar capital market, hundreds of trillions of dollars in size, versus Bitcoin, $500 billion in size, then you start to see, why there's only cold storage Bitcoin on the network and then the Lightning Network. And even now, the Lightning Network reference rate isn't widely reported. It's because there is a much higher risk profile associated with the Bitcoin network because there's such a low amount of liquidity. In the traditional finance capital market, you started seeing things like bonds emerge through time, more readily than you did with equities. Through time, people started parking their dollars in United States Treasuries, in corporate bonds, sort of the next rung up the ladder. So there definitely is a component of time. As time progresses, these instruments start to emerge, and then people within that capital market, they move up the risk curve themselves to these new instruments. So whereas in the very beginning, people owned physical gold, or they entrusted it with goldsmiths, they barely owned any bonds. Through time, as more and more people came into this sort of pool of liquidity, it became safer for people to venture up the risk curve. And I think, now, of course, today you've got things that are extremely risky, like venture capital, where it's, not 1,000,000 to 1, but as close as you can possibly get to 1,000,000 to 1 shot of lending your money to this guy and then, him building a business with it. That riskiness, that risk level, one of the reasons that tolerance exists is because there's such a deep and liquid market for United States dollar instruments that people are willing to venture that far out on the risk curve. And I think that's why, as of right now, that isn't the case for Bitcoin. We're at $500 billion, less than $500 billion right now in terms of total market capitalization. Not a lot of market participants are willing to dive into these waters and start swimming around. But as the liquidity in Bitcoin expands, as more people are comfortable taking risks, using their Bitcoin and parking it in the Lightning Network, and then maybe going out and leasing their channel liquidity, if they're great at channel management and they want to earn more yield, I think, to your point, that will naturally emerge through time. The way that I've illustrated it is definitely conceptual. It could very well emerge in this exact order, or it could not. There's a chance, and I do think that it will definitely be sporadic. But the one underlying factor, I think, is that as the liquidity in the Bitcoin network expands, and market participants are basically taking a look at this much bigger pool with a lot more water in it, and feeling more comfortable to move up the risk curve, that's when you'll start to see over time, gradually, more and more of these instruments start to appear as people are more willing to mobilize their Bitcoin, take it out of their cold cards, and put it to use.